Hi everyone, Sheena here to explain another one of our frequently asked questions. And today we're going to be talking about Roth conversions. So Roth conversions has been coming up a lot, and you might hear it in the news, you might hear about it reading articles about financial planning. And this discussion here really is for pre-retirees and retirees, because sometimes there are Roth conversion strategies that make sense, but a lot of times when we analyze the situation, it doesn't. And so I want to go into the details today. So first of all, what is a Roth conversion? So a Roth conversion involves moving money from your pre-tax retirement accounts, whether it be a pre-tax 401k or an IRA, and shifting that into Roth. And so when you do that, when you move money from a pre-tax retirement account into a Roth IRA or a Roth 401k, that means that you realize income in that year. So you'll end up paying taxes on that money moved. And really, let's pay attention to the tax brackets here. I've got a picture. This is the 2025 federal income tax rates, married filing jointly as well as single. And, one thing when it comes to Roth conversions that I always want to remind people of is that we analyze information that we know today about the situation and if it makes sense, not what we think about in the future. So, we think future tax rates are going up or going down, or we think about this kind of speculative issue. Well, we don't really know for sure. What we know for sure is what's going on today, what's going on with your income situation today, what your tax rates maybe were in the past, and we analyze data that way. So, we really need to know when we're converting dollars, what rate you're going to be converting and if that makes sense. So how it works. Let's take a look at this here. Considering $50,000, if you've got $50,000 in a pre-tax retirement account, should we be converting that or not? Well, what happens is if you don't convert that money, you don't pay any taxes. You only pay taxes when you withdraw that money later. But if it stays in that retirement account in a pre-tax situation, you will have to draw money out eventually at required minimum distribution age. If you decide that you maybe want to start converting money over time and say $50,000 in a given year, you do convert that money, you pay taxes, let's assume 20% all in with federal and state. And then once it's in that Roth account, it can grow tax-free forever, and you are not required to take required distributions. So it offers a way to kind of gently move money from the pre-tax situation that it is into one that's going to be tax-free forever, and you're not going to have to draw money off of it. So when does it make sense and when does it not make sense? The kind of perfect storm situation, if you kind of look off to the left, one scenario that we see a lot is in just low income years. Think about someone who is a couple years away from retirement. Well, they're probably in higher income years. They've been earning money. They're at their peak income situation. Perhaps maybe then they move to retirement and plan to delay Social Security. Well, if that's the case, they were in a high income situation. They're now in a lower income situation because they're not earning wages. They're not earning Social Security. Maybe they have some other forms of income, but it's certainly one of those temporarily low income years. And so if that's the case, that could be a good situation for a Roth conversion. Another criteria that we look at is, do you have cash to pay that additional income tax outside of the retirement account? The last thing we really want to do with a Roth conversion is to take more money out of the retirement account simply to pay the tax, because then that's money that you lose an opportunity to grow that and have it compound over time. So really, going back to the $50,000 example, if you take $50,000, convert it, you don't want to take more money to pay the tax. You want to use cash in the bank to pay the tax bill on that. Also, if you have a goal of reducing your required minimum distributions, if you have high pre-tax retirement balances, that could make sense. Also for legacy planning, if you really want your heirs to inherit money more in a tax-free nature, that's another reason to convert. So what about, when does it usually not make sense? The number one thing that I see, and I would say most conversations that I have with people around Roth conversions that ultimately end up in where we're not moving forward, is someone where their income is steady. Maybe their pre-retirement income compared to their retirement income, and also what they expect in the future, even when required minimum distributions are turned on. If their income is going to stay about the same, really it doesn't make sense to accelerate taxes and do Roth conversions. And I see that a lot. The next one there's no cash to pay to cover taxes. If all you've got in your savings and checking account is just kind of that typical emergency fund, enough to have set aside, and you really don't have an extra amount to pay taxes, that's usually a no-go, in my opinion. Also, too, when it usually doesn't make sense is if it would push you into a higher tax bracket. So, I mentioned earlier about paying attention to tax brackets. Well, you don't want to be pushed into a higher tax bracket when you're realizing more income from that conversion. That's less efficient. Another aspect of taxes to be aware of is possible increases in Medicare premiums. There are certain income thresholds, people who have higher income levels that pay extra money for their Medicare. And so if by realizing more income from the conversion pushes you up into those income levels where IRMA increases your Medicare premiums, that also is less efficient and less attractive. Also, too, for people who are later in life, people who are kind of in their RMD age, maybe 70s, 80s, because that money has less time to grow in a Roth, sometimes it makes less sense to do those conversions. Here, I wanted to talk about filling up the bracket, or filling up the bucket. This is one strategy that we use in a lot of Roth conversion cases. Maybe someone who is married or single in that 12% federal rate, and they kind of have some wiggle room to fill up that 12% marginal rate through conversions. That can be a really good strategy, whether or not they're in a low income year. But if they have the taxes to pay in their bank account and they can kind of fill up those lower buckets, or at least if it's a lower tax bracket for them, I really like that strategy, and that's one that we use the most. So in a nutshell here, I'm just going to break it down. Roth conversions, we need to be thoughtful about it, not automatic. Just because you read it in a news article or you heard a friend say that they're executing Roth conversions, it doesn't mean it makes sense for you. But it could be smart if you've got some income differential there where you have low income years that you could realize income at a lower rate, that you have the cash to pay the tax outside of the retirement account. You're earlier on in retirement, and so you have a long runway for that money to continue growing tax-free in a Roth IRA. Or if you want to leave that legacy, that inheritance to your kids or whomever your beneficiary is in a tax-free manner. I would avoid it if your income is pretty steady. Also, if you don't have the funds to pay those taxes, if you're later in life, there's less of a runway for those Roth IRA dollars to build. Or if you don't need the flexibility for having various buckets in retirement, the taxable, the pre-tax, and the tax-free. So these are some really good reasons to either consider Roth conversions or not to consider them. Certainly we're here if you want to dive into your situation in more detail. Here at Uncommon Sense Investing, we typically leave Roth IRA, Roth conversions towards quarter 4 for tax planning, just so that we can do accurate analysis. But if you want to talk more about your situation, happy to do that. Thanks for tuning in.